So they declare their very first cash dividend, celebrate a massive operational record, and then casually admit they miscalculated last quarter's margins by almost $20 million. Just a little Excel error. Welcome to WaterBridge, ticker WBI, looking at their fourth quarter numbers. Today is March 16th, 2026. And Miro, this one feels like a wild mix of infrastructure dominance and some genuinely questionable math.
Yeah, optimism with a broken spreadsheet. Look, the headline numbers look fine on the surface. Revenue ticked up 2% to $208.9 million. Their net loss actually improved by 27% to $13.6 million. But when you dig into the unit economics, the underlying profitability is quietly slipping.
Which is a problem when you were, sitting on roughly $1.46 billion in debt. And speaking of problems, quick reminder for everyone that this is strictly our personal opinion and not financial advice, so please do not trade based on our commentary. But investors certainly traded on this report today. The market did not buy the narrative at all.
No, they hated it. There was a weird, very sharp pre-market spike up to $28.50, but it completely evaporated before the open. The stock just bled out steadily during regular hours. It closed down about 6% at $23.94, and the midday earnings call at noon did absolutely nothing to change the momentum. The tape barely twitched.
Well, when you tell Wall Street you want to start paying a 5-cent dividend with that much leverage, people get skittish.
Right.
Even though their actual physical business is a beast. They basically act as the ultimate garbage men of the Permian.
Right. Managing produced water. It is the toxic byproduct of oil drilling.
Exactly. And it is incredibly sticky. They handle the waste that E&P companies literally cannot operate without getting rid of. The COO even pointed out they hit a single-day record of 2.9 million barrels handled, just acting as this massive regional shock absorber when producers flood the system with new wells.
The volume capacity is a huge moat, no doubt about it. Overall volumes averaged 2.6 million barrels a day for the quarter, up about 1%. The issue is what they actually earn on each of those barrels. Gross margin dropped from 22 cents down to 18 cents, and adjusted operating margin came in at $108.9 million. Let me say that better. It slipped compared to their newly revised third quarter numbers.
Yes, the infamous calculation workbook mistake. Let us get right into the details on that, because waving away $20 million as an immaterial formula error is something we really need to unpack.
Right. Well, let us be precise about the scale of this. They originally told the market their third quarter adjusted operating margin was $130.8 million. And then they quietly slip in a footnote saying it was actually $111 million.
That is almost a $20 million haircut. You do not just hand wave a 15% drop in your premier profitability metric.
You do if you can blame the spreadsheet. Literally, they said, and this is the exact quote, the error resulted from a formula error in our pro forma non-GAAP calculation workbook.
An Excel mistake. We have all dragged a formula one cell too far, but geez, for a newly minted public company, that is terrifying.
Well, it's terrifying because Wall Street prices them entirely on these adjusted metrics. The company said the corrections had no impact on previously reported GAAP results, which is technically true, but nobody's looking at the GAAP net loss to value this business. They're looking at adjusted EBITDA.
Right, exactly. And if your internal controls are that fragile right after an IPO, investors are going to wonder what else might be miscalculated. Mislinked.
No, that's exactly the issue. It just erodes trust, especially when you're simultaneously asking investors to trust your massive spending plans, which is the other giant red flag in this report.
Oh, the capital expenditures. Let's talk about that, because the 2026 bill is just enormous.
Yeah, it's massive. They're projecting, I think, somewhere between $430 and $490 million in CapEx for next year. And remember, their guided adjusted EBITDA for the same period maxes out at $460 million.
So they're basically spending every single adjusted dollar they bring in. Probably more. What are they actually building with all that cash?
Mostly it's the Speedway pipeline and the new Devon infrastructure. The interesting part is they're deliberately pulling this cash spend forward. The Devon contract doesn't even start until mid-2027.
But they're front-loading the construction costs now. Why would they do that when capital is not exactly cheap?
Well, because the E&P clients are just terrified of bottlenecks. When you're a producer bringing massive multi-well pads online, you need absolute flow assurance. If you can't move the wastewater, you literally have to shut down the oil pumps. So WaterBridge is willing to drag down their near-term free cash flow just to de-risk the timeline and lock in these 10-year minimum volume commitments.
Wow. So they are basically paying a premium in early cash burn to prove they are reliable, which, okay, I get that operationally. But you add that to the regulatory risks they're facing, and the math gets really tight.
Oh, you mean the orphan well situation?
Yeah, they got an enforcement notice from the Railroad Commission of Texas. The state wants up to $7 million for plugging an orphan well near one of their facilities. WaterBridge says the claim is completely meritless, so they have not actually accrued the cost yet.
Right, but that is kind of an existential overhang. Even if they win this one, state environmental pressure is not going away. When you operate underground water injection at this scale, you are constantly fighting the risk of disputes shutting down your pore space.
Exactly. And $7 million here, a $20 million Excel oopsie there. It really adds up when your balance sheet is stretched. Speaking of which, how does all this CapEx square with the debt load?
It is a total tightrope walk. CFO Scott McNeely explicitly told analysts, and I will quote him here, our covenant net leverage ratio was 3.3 times at the end of the year, and we remain committed to our long-term goal to be under 3 times levered.
Under 3 times. But wait, they're at 3.3 right now with a mountain of CapEx looming, and they just declared a cash dividend?
Yeah. A 5-cent quarterly dividend.
I'm sorry, but how do you reconcile that? You're heavily leveraged, you're spending $500 million to build out a pipeline 2 years early, and you're throwing a yield to shareholders? It feels like they're trying to be a sleepy utility and a hypergrowth infrastructure play at the exact same time.
You're seeing the contradiction perfectly, because usually a company with $1.46 billion in debt and negative post-CapEx cash flow would be furiously paying down the revolver, not establishing a recurring dividend payout.
I kind of feels like a shiny object, like they're trying to distract dividend hunters from the fact that gross margins just shrank.
That's one interpretation. The more generous reading is that they know the back half of 2026 is going to be a cash machine once the BPX Kraken pipeline ramps up and Speedway Phase 1 goes live. They're just bridging the gap until the heavy infrastructure starts printing money.
Okay, fair. So they're basically betting the farm on this new infrastructure executing flawlessly. But given they just had a $20 million Excel oopsie, flawlessly might be a tall order. So where does this leave them heading into next quarter?
Well, it leaves them playing a very deliberate game of expectations. If you look at their full-year guidance, they are projecting adjusted EBITDA between $420 and $460 million. But the real tell is the baseline they used to get there.
Oh, you mean the oil price deck? Because that actually stood out to me, too.
Right. The CFO, Scott McNeely, explicitly pointed out their outlook was built on producer feedback when oil was in the mid to high 50s. And he called that outlook very conservative now, especially in the context of current prices, meaning they have essentially built in a massive macroeconomic cushion.
Okay, so setting the bar comfortably low, if crude just holds its ground, producers keep drilling, and WaterBridge gets to breeze right past those estimates, it is a pretty classic sandbagging move.
It is, and honestly, you have to respect the underlying strategy. I mean, despite the spreadsheet fiasco and the massive debt, the physical moat they are digging is undeniable. Mm-hmm. Drillers literally cannot pump oil without securing this pore space first. So if WaterBridge can just push through this brutal upfront CapEx cycle, that back half of 2026 is going to throw off some serious cash.
It really is such a paradox. They are running the absolute most unglamorous plumbing in the Permian Basin, but they are playing high-stakes financial chess to pull it off. It feels like this entire report is just the story of a transition year. They're dragging their short-term optics just to lock up a 10-year monopoly.
That is the bet. It's basically highly levered growing pains. But look, if they actually secure that regional dominance, the whole dividend strategy will look brilliant in retrospect. Just, assuming they somebody audits the internal formulas next time.
Let us just hope they spring for a premium software subscription by next quarter, because with this much money on the line, they're definitely going to need it.
All right, my brain is officially full for today. If you want these earnings chats to just naturally show up in your feed, feel free to follow the podcast. Just a quick reminder that this conversation is actually generated with the help of AI to turn those dense SEC filings into something you can easily listen to. We would love to know what tickers you want us to cover next, so email us at earningsunscripted@datamadness.ca or grab the X link in the show notes. Thanks for hanging out, and catch you later.
See you out there.